Oh, welcome into another daily editorial here on the KE Report, and another daily editorial where we are focusing on the precious metals sector, balancing out at least some of the short-term technicals with some of the longer-term fundamental drivers for gold especially. I am chatting with Jordan Roy-Byrne, founder and editor of The Daily Gold. Now, Jordan, I want to follow up on the interview that I had with Dave Erfle where we looked at the GDX chart, and he mentioned that it was, or looked like, a descending triangle really ever since that peak in early September and lower highs. However, the lows are not exactly at the same level. We had the first low come in kind of September 13th at about 26.60, and then the next low, October 1st, 26.51. So those are pretty close. But then the third low that came in the middle of October, that was 26.18. So that's a little bit lower of a low, and even this recent low more in line with that low that we just saw back in the beginning of October. What do you have to say about some of the commentators calling this a descending triangle?
Well, it's not a descending triangle, and that's been proven over the action of the last 6 or 7 trading days. Because as you noted, the first low is in the middle of September, then the second low, which is at the very, very beginning of October, it was around the same level. Even that one looks a little bit lower than the first one, but nevertheless, those first two are similar. And after the rally that followed that, when GDX was rolling over again, you could say, yeah, this could be a descending triangle. But what happened was it looked like you had this big breakdown. I think it looks like on the 14th, maybe a day earlier, a day after, you had this big breakdown below those lows, very bearish candle. But after that, you had 3 days of a move up, kind of invalidating the potential breakdown from that pattern. So, I mean, looking at it now, it's not a descending triangle. And again, I mean, if you thought this was a descending triangle, there's a potential downside target of 4.5. You could call it 26.5. So that would bring you down to 22. I mean, we talked about this, Corey, a couple of weeks ago when the head and shoulders pattern appeared to be potentially there on the charts. And I said, well, with GDX, if you think this is a head and shoulders, we're going back down to 21. We're going to fill the gap and retrace the entire move. And it doesn't make sense to me that, fundamentally you would see this huge move higher based on a shift in Fed policy over a couple of months. And then suddenly after that, there's this bearish pattern that's going to give back the entire thing. Like, markets just don't really work like that. And, sometimes, a lot of this faulty technical analysis, it comes from only looking at the chart and not considering other factors. So even though it looked like a head and shoulders pattern, but I told you it wasn't, because you have to really understand these patterns and how they play out. And then at the same time, you have to understand the fundamentals of the market and what's really happening. And so the head and shoulders, and even the descending triangle, that potential pattern that projects down to 22. So that projects a huge decline, like the head and shoulders, just suddenly giving up the entire move. Like, it doesn't make any sense that we'd have this huge breakout in a great move over a couple of months, and then suddenly it would completely, entirely reverse itself, and all those gains would be gone. 100% of the gains basically would be gone in the next couple of months. It doesn't make any sense, especially with the fundamentals of the market. I know we're going to talk about the yield curve and inflation, but that's just what the people really have to be careful of, is just falling for a lot of this chart analysis where people are they're looking at the chart and only the chart. They're not considering what's happening with sentiment and positioning and fundamentals at the same time. So, and Corey, I mean, we've talked we've done these interviews, I think, for almost 3 years. And like, you would probably say my best market timing calls have been influenced by fundamentals, not just looking at the chart by itself. So that's something I try and do, is really, look at the technicals, but match it with fundamentals and positioning, kind of put that all together to get a view of, what's really happening in the market and the potential for where it could be going.
Okay, this is very important to outline because you know what? The chart is showing just this general short term downtrend that we're in, but dating back to, yeah, your, I think, most important call, and one that we were waiting for it to happen when gold would truly break out. That was a shift in Fed policy, which we finally got at the tail end of last year. And really throughout this year, the Fed has followed through on that shift in policy with rate cuts. However, and maybe you'll disagree with this, in the last month to two, we have seen, well, U.S. markets do a little bit better, a little bit more optimism come out of the trade front. We've seen a little bit of a reprieve from this fear that's in the market. And even though expectations are still of a of a Fed cut coming up, and you know what, the Fed has actually started expanding its balance sheet, so that can also be bullish for gold. Fact of the matter is, yields have started to tick up, and now, you know what, the Fed, I think, does have a reason not to cut rates. Is that the reason for the short-term downtrend, though? Are we seeing a bit of a transition away from what seemed like all bullish comments towards gold in the longer-term sense?
Yes, I mean there's a lot to unpack there, but yes, that's why technically I was calling for this correction because in the summer you could see with respect to gold that the strong resistance is at 1550. So it made a lot of sense that that's probably when gold's rally would stop, when we'd at least get a pause. And at the same time, you had GDX rally up to, it broke above 25, and then you have this huge resistance, multi-year, 6-year resistance at 31.32. So it made a lot of sense that this strong move is going to peak with respect to GDX at 31 to 32, and then for gold around 1550. So after that, the question is, how long is the correction and consolidation going to last? I mean, is this going to be a short little blip, or is it something that's going to be sustained? And the fact that basically, in my opinion, after the Fed cuts, the Fed is going to pause for a while. And so that is why this correction in precious metals is going to continue. It's going to consolidate. That's why I mentioned months. I've been talking about this since the end of summer. It's going to be a process that takes months, not just a month or two. But the first thing, with that being said, Corey, that doesn't mean that corrections are a function of price and time. So GDX, I've been talking about 24, 25. A couple of days ago, I made a low, or I don't know if it was yesterday or the day before, a low in the low 26s. So it's come down to 26 basically. And there's not a whole lot of downside in terms of price, Corey. It could come down to 24, 25. I mean, I do want to be a buyer when it hits those levels. But that being said, Corey, we'll get a bounce from there. We can probably test 24 or 25, and the market could still consolidate, well into next year. So, you have a price and time component, and just because we're going to hit 24, 25, that doesn't mean that the market is suddenly going to resume its uptrend, zoom higher, and break past 31, 32. I'm expecting that, we're going to see this correction kind of turn into a consolidation, and then that could last for several months, as I said, well into next year. And the key point in that, Corey, is because you're seeing a fundamental shift. The precious metals recently have been driven by the Fed shifting course and doing these rate cuts. But it's my opinion, based on how the market is trading, and also looking at the economy and looking at global markets, looking at the U.S. market, these things are strengthening. The dollar's cracking a little bit. So it looks to me that the Fed is probably going to pause for a number of months, and therefore precious metals need something else. They need another reason for capital to come in, push them higher. But a quick point on the Fed cuts, Corey. They're probably going to do this cut this week, or next week, whenever the next Fed meeting is, because it's 90% priced in coming into the week. But if we look at that, Corey, precious metal, they're not making a new high. Like, they're correcting. They're well off the high. Same thing with gold and GDX. So what does that tell you? I mean, they're not, the first couple cuts, they were rising into the cuts. They were rising after the cuts. Now with this cut, we're still correcting. We're not even testing highs. We're not, much less even breaking into new highs. So what does that tell you? That Fed cuts have already been discounted. And it tells you that, there could be a Fed pause coming up for several months. So I know there's a lot to unpack there, but that's kind of how I'm analyzing the market with respect to both technicals and fundamentals, which focuses on Fed policy and also the yield curve, which I know you want to ask me about.
Yeah, right before we get into the yield curve, and I don't want to oversimplify it, but I think that's a perfect comment that we are going into another what looks like Fed rate cut, and the market is not benefiting from this on the back end. We are not testing new highs. We are not gradually rising into this cut. We'll see if there's a big change that comes after it, but that is, again, just not the bullish sign that the Uber bulls would need. But still, this sell-off has been, I think, very systematic and not devastating for the long-term picture whatsoever. When it comes to the yield curve has been ticking up, the long end moving a bit higher. And if the Fed, again, cuts rates or actually doesn't raise rates, if this yield curve keeps moving, then that means a potentially prolonged steepening to the yield curve. How is this important for precious metals investors in your eyes?
Okay, it's very important, Corey, because a steepening yield curve reflects either, you have risk aversion, recessionary fears, Fed cutting rates aggressively, or the other scenario is the curve can steepen because short-term rates, which the Fed basically controls, they're flat and they don't really go higher, but the long-term rates are rising and rising aggressively because inflation expectations are rising. So, to simplify it, you either have rising inflation and inflation expectations, or you have rate cuts. So if the Fed is done cutting rates, let's just think, if that's a scenario, they're done cutting rates for another year or two until this thing rolls over again, then what precious metals need to, have this next big breakout move, they need inflation and inflation expectations to rise. So they would need the long end of the curve, the 10-year yield, for example, they would need that to rise aggressively. Inflation expectations pick up. The dollar, it's already cracked. Maybe the dollar keeps driving lower to the mid-low 90s on the dollar index. And when all that's happening, as long as the Fed doesn't do anything, that's very bullish for precious metals. The thing that would hurt precious metals is if we saw inflation expectations rise, the dollar continues to move lower, the CPI's ticking up, would be if the Fed says, oh, well, we're thinking maybe we're going to do a rate hike or two, just maybe one or two. If they start talking about that would not be good for precious metals. And following through on that, more importantly. So that's basically, I don't know, Corey, what the driver of the next big move is going to be in precious metals. I don't know if it's going to be renewed rate cuts in the Fed, or from the Fed, I should say, or if it's the Fed pauses, but we really start to see inflation and inflation expectations rise. I don't know which one it's going to be, but assuming the Fed is going to pause after this October cut, that temporary fundamental shift explains why gold and gold stocks and silver as well are probably going to consolidate into next year. So that's something we have to continue to watch. See how precious metals perform. Do they stabilize above these support levels? Are they basing above these support levels after they test them? Are they consolidating in a bullish fashion? Those are the things that we're going to watch in the months ahead. Because if they are consolidating bullishly and holding above support levels in bullish fashion, then that means the market is starting to discount either renewed rate cuts from the Fed, or they're starting to discount the idea that, look, the Fed is going to do nothing, but inflation expectations are going to rise. And so that's also bullish for precious metals. So there's really two scenarios for the next move to consider. And in both cases, you have a steepening yield curve, but, don't rule out either one yet. But, keep your eye on, bond yields with respect to, you can look at the 2-year and the 10-year, because the 2-year is a proxy for the Fed funds. If we continue to see the 10-year rising faster than the 2-year, that's also a very good sign for precious metals. But I think it's going to take a little bit of time for the market to digest these new potential developments, and that goes hand in hand with a continued consolidation in gold and gold stocks after they test these strong support levels.
Yeah, you know what? Even a consolidation after testing the support levels, that is still positive because they are consolidating at higher levels. So this is going to go down, I believe, as a very good year for the precious metals and set up for potentially a very good year next year. Jordan, just a quick comment. We've talked a lot about the Fed cutting rates. What about now this narrative of the Fed expanding the balance sheet? They haven't expanded their balance sheet in almost a decade. Last time they did that, it was very good for the precious metals. Slightly a different scenario from back then after a major crash, but how is this playing into some of your analysis for gold?
I don't think it really matters for gold, and the reason why is because it doesn't influence the biggest driver, which is real interest rates, and so Fed policy with respect to interest rates. So that's really the key focus for gold. So, I mean, if they're doing the I mean, with this new QE, I mean, you got to love how they said, we're doing QE, but it's not really QE. I mean, just they're talking out of both sides of their mouth. But if the QE is accompanied by further rate cuts and, they're cutting rates next year again, because they want to make the QE easier. I mean, in that scenario, that's bullish for precious metals. But if it's just, the Fed is keeping rates where they are and they're going to do QE, that doesn't really help precious metals. The QE, and we might see this in the years ahead. I mean, if the QE is used in a situation where it's going to pay for, the Fed is basically going to pay for, they're going to start monetizing, increasing government spending and that sort of thing, and that gets money into the economy and it's inflationary, then that kind of results from QE is bullish for precious metals. But if it's just QE like we saw in recent years, without any additional rate cuts, then it's not necessarily bullish for precious metals. So long story short, focus on Fed policy with respect to rates. The QE really isn't a market mover for precious metals right now.
All right, Jordan, we're wrapping it up there. I think very good comments and very important comments for precious metals investors to focus on regarding some of the short-term moves and then also into next year and honestly what really matters for the metals sector. Jordan, great chatting with you. Everyone click that link below. Go visit Jordan's website, The Daily Gold, to keep up with both his technical and fundamental outlooks for the precious metals. Thanks, Jordan.